Our monthly webinar with Fritz Meyer. My name is Brian Shanahan. Today is Tuesday, June 7th, a beautiful day here in New York. Welcome to all you.
I'm going to do this month's presentation a little bit differently. In the past, if you've been tuned in, I have included the entire PowerPoint presentation consisting of 80-some slides, and I've been skipping over some of those in the interest of time. This time, I have pared the list of slides down to 50, and I'm going to hit every one of these 50 slides. But just recognize that the full PowerPoint presentation then would include 30 more slides on topics that I won't directly address today, but topics which I think are also can be rather important and on which we periodically get questions. Okay, I'm going to talk about the economy, inflation, the stock market, the bond market, and finally wrap it up with investment strategy. The story on the economy, I think, should start here with the index of leading economic indicators.
Hey, Fritz.
And the simple picture here, and I think the simple story here is that the LEI has just posted the most powerful recovery coming out of recession that we've ever seen post-World War II. And now, in part, that's a function of how deep the recession was. And you've heard me say this before, perhaps, in previous months. By the way, I will be repeating some of my points from last month because some of these points deserve monthly repetition. But also this month, I'm going to go into some new areas with some new discussion and analysis that you haven't seen before. But the point here that I wanted to make this month with respect to the index of leading economic indicators is that most recently we've seen a stutter, in other words, a downtick in the April data. But it's very similar, in fact, to the pause that we saw last summer, so you can see that. And the fundamental takeaway here is that the LEI really needs to substantially start rolling over before you get too concerned about rolling back into recession, a double dip, something like that. And then here on the right, I circled the Conference Board's most recent commentary with respect to their data. Economic growth will likely continue through the summer and fall, but the pace may be choppy. And I think that's the best way to look at the economic outlook. I am firmly in the no double dip camp. In other words, we don't slide back into recession. I think we are looking at a brief pause, a slowdown, a soft patch, whatever you want to say, but we're going to see a reacceleration of growth later in the year. The ISM Purchasing Manager.
Fritz, sorry to interrupt. Can you just make sure put it into full screen mode and slideshow mode? You see some icons. It makes it a little bit smaller. In the bottom right corner, there's an icon there to quickly do it all the way to the right there.
Oh, good. Okay.
Thanks a lot. All right, go ahead.
It?
Yep, you're good. You're good now. Thanks.
Good. I'm not a tech wizard, so thank you, Brian. Let's see. The ISM Purchasing Manager survey is where I stopped, and I just wanted to comment also on this specific piece of monthly economic data because it also is very high profile. And this, of course, took a big downtick in the May data reported last week. So I wanted to show you the historic context here, which I think is so important. First of all, it's not uncommon to have lots of volatility in this data series. Secondly, we saw a similar contraction last summer in last year's soft patch. And number three, I wanted to show you, for example, the entire decade of the 90s in which you had lots of volatility. And in fact, this measure slumped, for example, in 1995, 96, this slumped well below the 50 mark, which is the demarcation between expansion and contraction. And that in itself was not sufficient to put the economy into recession. The vertical clear bands here represent recession. So the bottom line here is that I'm not concerned about this. At least until further notice and until we see lots more data that manufacturing is just caving in. I'm not too concerned about this ISM Purchasing Manager's number that we got last week. And finally, I wanted to highlight what I've circled here, again from the ISM, their commentary dated June 1st. Manufacturing employment continues to show good momentum for the year. So notwithstanding, again, the disappointing jobs number we got last week, manufacturing employment actually has showed lots of momentum, and I expect it to remain reasonably healthy. Okay, the biggest single problem that we're seeing in the economic data today relates directly to the drop-off in vehicle manufacturing and sales. And we can trace this right back to the Japanese parts shortage problem, which stems from the earthquake and the subsequent tsunami. You've probably been reading about this, but I wanted to show you the numbers in this regard because it really is very significant. So specifically, if you look at May car sales reported last week, what you see here is a very significant downtick from the April number, from 13 million annual run rate to 11.8. And again, this is very significant, and the pass-through or the effect on the economy is, I think, going to play itself out along the lines indicated in this slide. So what you're looking at here is vehicle production's historic contribution to total GDP growth. So you might look at the top line in this chart and conclude that historically GDP has grown about 3.1%. That's the annual from 2000 to before the economy went into a tailspin. About 3.1% GDP growth was on average. And vehicle production's contribution to that was very, very small. In other words, just a couple tenths of a percent. But what's happened most recently is this enormous exaggerated volatility. Vehicle manufacturing's contribution to total GDP growth was over 1% of the 1.8% GDP growth recorded in the first quarter. Now what's happening is, with this very abrupt contraction in vehicle production and vehicle sales, then UBS's economists, and I picked them because they are representative of how economists are generally making these calculations, then what we're expecting is vehicle sales is about to take away a full 1% from GDP growth in the second quarter. And then as parts come back online and pent-up demand for cars kicks back in, most economists are then expecting a very strong snapback such that vehicle production contributes a net 1.5% to third quarter GDP growth. In other words, that is huge by the historic comparison of vehicle production's contribution to total GDP growth. I hope I'm being clear here, but we're seeing the point is that we're seeing a very a huge magnification of vehicle production's impact on total economic, the total GDP tally is probably the best way to say this. So if you said, well, what do economists generally then, what are the smartest guys in the economics forecasting profession believe collectively with respect to the outlook? The best I can do there is go to the most recent Wall Street Journal survey of the 55 economists, most recently taken May 6th through 11th, and this will be this June survey is being taken as we speak. So the June survey results will be out in probably 10 days from now. But the point here is that up until very recently, meaning in the last 2 weeks, and particularly after the vehicle sales numbers reported last week, economists had been very sanguine in the outlook, saying this is a soft patch. Yes, 1.8% growth in the first quarter, but we're going to have a pretty quick snapback to in excess of 3% GDP growth in the next several quarters. And I think that remains the case. In other words, as I read most economists' revised forecasts, what they're saying is, well, probably the second quarter indicated here expected over 3% GDP growth won't be anything close to that. It might be another 2% quarter, but then most economists are sticking with their story that in the third and fourth quarters we're going to see a resumption of pretty healthy economic growth. And I'm going to get into further detail as to why that may be a reasonable assumption here in a second, but I just wanted to show you these numbers. This is the latest consensus forecast for economic growth looking out 4 quarters. It will be revised lower in the immediate quarter and perhaps in the third quarter, but it's not going to change significantly with respect to economists' general assumption. In other words, there is no reason for economists generally to believe that we're going into a double-dip recession or anything like that. Most economists are saying, gee, this movie looks a lot like last summer's movie, soft patch and a resumption of growth later in the year. This is the most recent payrolls data that was reported last week. Again, a very disappointing figure, but again, I wanted to show you the historic context, and which is, for example, coming out of the last recession, you can see that in 2003, hiring went back into the tank. In fact, notwithstanding the fact that the economy continued to recover at a very solid clip, but you can see that we lost 200,000 jobs in 1 month, in approximately January of 2003, even though we were well back on the recovery trail. So I'm not too concerned about 1 month's data point with respect to new jobs. The overriding trend here, the underlying trend, the important trend is that we have substantially recovered. We are back into net new job formation, and that trend, I think, will persist until we see lots more data to the contrary. The unemployment rate itself, I think, is important to comment on because of all of the monthly statistics, and if you've been on this call, you've heard me say this before, but this is one of those points that I think deserves constant repetition because the unemployment rate, I think, is probably the highest profile single economic statistic that probably is more responsible for coloring your client's perception of the economic outlook than any other single number. In other words, if the nightly news or if your hometown newspaper is going to focus and do a story on the economy, they're going to talk about jobs, and they are assuredly going to cite the 9.1% unemployment rate. And I think that has a great impact, the greatest single impact on people's perception of the health of the economy currently and the economic outlook. And here's my point. This is such a laggard to the economic cycle that when it comes to investing and regaining confidence in the stock market, the unemployment rate is such a laggard to the cycle that I would suggest you pay no attention. And that may sound like a radical statement, but it's absolutely true. And the reason I say that is look at the history. Coming out of the last recession in January of 2002, you can see the unemployment rate actually continued to move significantly higher and didn't peak for 19 months, even as economic output and earnings were surging and the stock market was surging. Unemployment was rising? How does this work? See, that's what is in so many people's consciousness. And my point is, look, employment is a laggard to the economic cycle. This is called a jobless recovery. But because economic output can be surging and profits can be surging even as you have sustained high unemployment, it means that stocks can move very significantly even as the job picture remains pretty dismal. I wanted to talk about housing starts again because last week we saw again the home price index. That's not housing starts, but the two tie to one another. I wanted to just show you this data because there is consistently a lot of focus on the housing sector. What you see here so clearly is that from the May 2009 bottom and the inauguration of the homebuyers tax credit, the federal policy that ended 1 year later, you can see how new home construction was, I would call it, artificially stimulated. And what we've been seeing then for the last 12 months, from April 2010 end of the tax credit to the most recent April housing start number, you can see it's been give back for 12 months. It's a really symmetrical picture. And I think the conclusion here is housing starts are bumping along the bottom, not getting worse particularly, but not getting much better. It is interesting to note the red data series. And the Mortgage Bankers Association continues to forecast a recovery in housing starts. They've been wrong, wrong, wrong. They've been way too optimistic about when housing starts will recover. I tend to use their forecast because they, of all groups in the country, are actually in a position of surveying home building companies every month. So one would think that they have the best handle on this, but they haven't been very particularly accurate in forecasting this recovery in housing starts. Nonetheless, this is their forecast. The reason they're making that forecast is in this picture. And I wanted to just pass along fundamental new home construction arithmetic to you. Obviously, trying to guess when housing starts will recover is very problematic, but I think in the end, housing starts do have home construction does have a very bright future. And it's very simple, because in the end, housing, new home construction, whether single or multiple family, is a function of population growth. It's a demographic function. And what you see so clearly in this chart is, yeah, there's volatility, but the bottom line arithmetic is historically in the United States we've added approximately 3 million new bodies every year, so you need to build approximately on average 1.5 million new units every year to absorb the demand for new shelter. And so in 2005, you can see we hit a peak of 2 million annual run rate in new home construction. Well, obviously, we were overbuilding by about 500,000 annual run rate. Now we've been underbuilding. We've been absorbing the excess supply, the inventory overhang, and it looks like we've turned the corner here. And at some point, then, I think one can reasonably assume that new home construction reverts to the historic trend rate of growth. The demographic-driven rate of demand of about 1.5 million per year. I just think that's an important consideration to point out. Okay, back to this question of double dip or not. In other words, in the last couple of weeks, I've started to see headlines once again, soft patch or double dip, and guys like Rubini and Rosenberg and other bears on the economy have been very visible and vocal, talking about we're going back into recession. What is reasonable to believe in this respect? So here I wanted to take you back to basic GDP arithmetic. And in this slide, simply highlight the fact that 69%, let's call it 70% of the GDP is consumer spending. And you all know this number, but I wanted to show you this breakdown. As a matter of fact, spending on durable goods is a pretty small piece. That would include autos, by the way. But spending on durable goods, manufactured goods, durable and non-durable, is only 24% of the total GDP pie. Services is almost double that. In other words, we are predominantly a consumer-driven economy, which is dominated by spending on services. And the reason I make this point is because growth in demand for services is almost impervious to recession. And also, growth in demand for services is a demographic function, whereas growth in demand for manufactured goods has lots more to do with the economic cycle and also inventory cycles and so forth. The other point that I wanted to make with respect to this chart is the investment category. By the way, GDP equals C plus I plus G, consumption, investment, and government spending. I've left exports out of this equation because they are de minimis. But the investment category, too, is one of the most volatile through the economic cycle. In other words, when we go into recession, companies simply terminate, they stop investing. But now we have come back into a recovery cycle in investment, and investment company investing, CapEx, and inventory build is once again contributing to GDP growth. My point is that whereas investment as a category is pretty small in the overall, it can be very volatile, and it can experience very large percentage swings, which feed through to volatility in the aggregate GDP figure. Okay. What I started to say here is it is reasonable, at least in my view, to assume that it is a soft patch and nothing worse, because I think the demand for services and also other personal consumption categories, non-durable goods and durable goods, will in fact come back and remain strong in the second, third, and fourth quarters. The reason I say that is in this chart. In other words, going back to this chart, you're looking at the personal consumption category, 69% of the GDP, is this second line on this page. In other words, personal outlays here, the 70% of GDP that you so often hear referred to is this data series. I took this right out of the GDP accounts. Okay, what's driving it? The answer to that question is rising disposable personal income. income drives spending. And the $64 question then, as we look into next quarter and the following quarter and the fourth quarter, is the trend here in rising disposable personal income then sustainable, likely to be sustained? And I think the answer is yes. But I wanted to show you this data series. I wanted to show you the historic correlation of income to spending. And it's disposable personal income and almost exclusively that drives GDP growth fundamentally over, in other words, disposable personal income. Rising wages drive 70% of GDP, and I think that trend remains intact. I'm going to get to the $64 question here, whether DPI here is sustained in this trend in 1 second. But before I leave the slide, one other comment, and that's personal saving. 3 years ago, and all of you on this call remember that it wasn't that long ago that you couldn't go a day or a week without someone commenting on this notion that Americans are spending every last nickel of their monthly paycheck. The savings rate was 0, and that was absolutely true. But the savings rate has recovered, and it looks like it's settling out at about 5%. April's savings rate was 4.9%. My point here is that it is surprising, I think. It is impressive to me how aggressively Americans have rebuilt household liquidity. And that is fuel for continued growth in personal spending. I think that number is significant. Okay, back to the $64 question. In other words, what's driving that top line? And the answer is found in this chart. In this chart, what I've done is to deconstruct the, in other words, look behind at the drivers, individual drivers of disposable personal income, the key driver of economic growth. The answer here is that employee compensation is the lion's share of total consumer income. And just in passing, it's important to note that employee compensation in this chart is on the left-hand scale. All other contributions to consumer income are on the right-hand scale, which is simply to point out that monthly paychecks dwarf all other sources of consumer income. And you can see this trend, this rising and very strong recovery trend in employee compensation. What's driving this is, up here, rising hours worked, average wages, and payroll gains. And as economists look and analyze each of these individual drivers of monthly pay, what they're concluding is, yes, this trend very likely is sustainable. And it likely will be sustained. And you can see actually that the rate of change here has been accelerating in recent months. Okay, with a weak May jobs number, maybe we get some temporary, some more of this. But I think it is important to understand, and I think conclude that probably this trend remains intact. And I think that's very good news then for the fundamental trend in consumer spending, income drives spending. The other important point, I guess, just before I leave the slide, is government transfer payments. This is the gift that just keeps on giving. And I say that perhaps facetiously, but this is Medicare, Medicaid, Social Security, and unemployment claims. And I think you're hard-pressed to argue that this government transfer payments won't continue to rise. But although it's a fairly small share of total personal income, nonetheless, it's a very consistent driver of growth in rising personal income. Okay, I wanted to go talk about this concept because once again last week, the Case-Shiller home price, national home price index went down. So a lot of the bears on the economic outlook, again, are harping all about the decline in homeowner equity. In other words, house prices go down, you got a fixed level of debt, homeowner equity contracts, making a big deal out of the negative wealth effect. In other words, one of the bears' key arguments on the economy has been the negative wealth effect. We've all seen an enormous contraction in household net worth driven principally by a contraction in homeowner net equity. Isn't that going to be a huge drag on consumer spending? I don't think it is, and I think this is an area that is very commonly misunderstood. So I wanted to show you the breakdown of household net worth. If you simply net total consumer debt against total tangible assets, I think you end up with a good proxy for homeowners' net equity in real estate up here. In other words, tangible assets is principally real estate, liabilities is principally mortgage debt coming from these Fed statistics. What you end up with is aggregate household net equity in real estate. And my point here is that, surprisingly, this is a fairly small piece of the total household net worth pie. And believe it or not, households' total financial assets is the lion's share of household net worth. I think an important consideration. And so, sure, we may have more very soft, a lot of softness, maybe even more declines in national home prices. But I think that as a factor behind consumer spending is being way overblown. And here's the proof of what I'm saying, at least in my mind. This is the history of household net worth versus consumer spending. The two lines that you saw earlier are repeated here in this slide. This is consumer income, this is consumer spending. When you look at this slide, does it appear to you as though household net worth, or put it this way, the last episode of a big contraction in household net worth was responsible for a corresponding enormous slide or downtick in consumer spending? And the answer is very obviously no. In fact, the change in the rate of growth in spending is almost imperceptible here, notwithstanding this enormous contraction in household net worth in the last recession and stock market bubble bursting, when financial assets and home prices did this. So yes, we've seen this enormous contraction in household net worth, but what we are actually 4 quarters into recovery in household net worth. But my point is, look, I think its effect on consumer spending in the aggregate is being vastly overblown. What really drives spending is consumer income. Again, a point that I keep going back to. If you have rising consumer income, you're going to have rising spending. And I think this consideration of negative wealth effect is being overdone. And by the way, my conclusion in this regard has been corroborated very specifically by this Federal Reserve paper published in November of 2009. Declining household wealth has a relatively small applied negative impact. So I'm just saying that a lot of the bears on the economy make a lot out of declining home prices, and I think that actually has and will continue to have fairly little effect on aggregate consumer spending. The most often cited statistic by the bears on the economy is this ramp in household debt, aggregate household debt. And specifically, the number going back almost 20 years from 4 trillion to 14 trillion. Again, if you've been on this call before, you've heard me go through this. But again, this is again one of those points that I think is so deserving of constant repetition, because it's the argument constantly that Rubini, Rosenberg, and other bears on the economy have been citing. Continuing to harp on this a piling up of household debt, and usually the statistic is presented in ratio format. Household debt to disposable personal income has approximately doubled here over the last 20 years, suggesting to many that consumers are tapped out. How can you possibly have a sustained recovery in consumer spending, a consumer-driven recovery, when consumers are wallowing under this mountain of household debt? My point with this statistic is that it's very misleading, and here's why. It's not the stock of household debt that matters. It's the flow of income versus the flow of debt service. In other words, you're comparing apples to oranges in this statistic. You're comparing a stock of debt to a flow of income. What you really need to do is what the Fed does in its financial obligations ratio. Compare the monthly flow of income to the monthly flow of expenses for the average household. And this takes you to a very different conclusion, and it's the proper conclusion, at least as far as I'm concerned. The financial obligations ratio is a calculation of the average household's ability to shoulder its debt burden. The Fed's calculating what percent of average monthly after-tax income does the average household have to set aside for all fixed recurring monthly obligations, including debt service. And the answer is about 16.5%. Does that surprise you? It surprises a lot of people that look at this chart. What it means is that the average American household has about 83% of monthly after-tax income left over to cover all other discretionary spending. And furthermore, on this basis, you can see that actually Americans are in better shape today than they've been throughout most of the last couple of decades. So I think this bodes well for this continued recovery in consumer spending, and that's why I say don't worry too much about double dip. I think we continue to see this consumer-led recovery, and the proof of this argument, at least as far as I'm concerned, is in this chart. In other words, monthly retail sales, lo and behold, have posted this astonishing, at least in the minds of the bears, recovery. And yeah, the bears on the economy will say, well, this isn't going to last, it's going to turn right around, blah, blah, blah. I don't believe it. This is completely inconsistent with the new normal hypothesis that we weren't going to see anytime soon a recovery in consumer spending-driven recovery. And lo and behold, that's been wrong, and I think it'll continue to be wrong. And it's for the reasons that I've cited, I think, up until this point in the presentation. The last point I want to make on with respect to the economic outlook has to do with crude oil prices versus recession. And this concern has been fading away in the last couple of weeks as oil prices have been coming off of the recent high. But I think I just wanted to pass along this data and make sure you know that this data is available in this presentation, because undoubtedly if oil ticks back up, we're going to start hearing people say, oh, at what point does crude oil derail the recovery? So here's the history in this regard, and you can see, yes, big spikes historically in the price of crude have preceded recession. Now, a couple of points, however. In the last decade, crude went from 20 to 147. That's a 600% increase, and it wasn't until the mortgage-related meltdown, in other words, entirely unrelated to the price of crude, did we go into severe recession. You had a 600% increase in the price of crude and before you went into recession, and even at that, you can't pin it on the price of oil. Here, we've gone from back from, let's say, 80 to 100. Most economists are saying we're not going to even get too concerned about going back into recession until 125 bucks a barrel. Most recently, I saw some very capable economists say $150 a barrel. The other point I wanted to make here is that historically these were supply shocks, whereas this rise in oil prices was demand-driven. That's a very important distinction as well. And I think this recovery in oil prices, too, has been demand-driven. In other words, you got an expanding global recovery. Sure, oil prices are going to go higher, but unlike a supply shock, is that going to put you into recession? I don't think so. This is just an interesting piece of data from the U.S. DOE, and it's turning out to be pretty darned accurate, which is why I pass it along. In March, the U.S. Department of Energy's most recent forecast for both crude oil and gasoline was this picture that you see. And what they were saying is, oh, yeah, we're going to see some uptick in gasoline prices, but then we're going to see it simmer down here, and gasoline prices aren't too much of a concern looking out a year. Well, so far, the DOE is looking pretty good in that projection, and that's actually good news with respect to the economy. I'm going to skip over this discussion of the long-term prospects for economic growth just in the interest of time here today. The punchline, though, is that unlike most developed economies in the rest of the world, in other words, Europe and Japan principally, the United States actually has very strong long-term prospects for economic growth compared to economic prospects long-term for Europe and Japan, because GDP growth potential, the basic drivers of economic growth for any economy are a function of productivity gains and long-term growth in the labor force. Demographics are destiny, and that's why I include this slide in this presentation all the time. This is 100 years of live births in the United States, and I think so many people know everything there is to know about the baby boom generation, but they really are totally unaware of the enormity of this echo boom generation coming behind my generation. In other words, already our kids' generation has surpassed our generation in size. And the import here is that what it means is that the labor force in the United States is expected to continue to grow indefinitely into the future. What's happening is we're having more entrants into the labor force than we can expect exiters, even though our boomer generation are set to start retiring in vastly increasing numbers. The punchline is they get more than replaced by echo boomers coming behind. So that if you look at the long term, the United Nations most recent long term estimates of growth in the labor force, U.S. versus rest of world, oh my God, you realize the United States actually has a very favorable long-term demographic profile compared to other developed economies, even compared to China, interestingly, because by virtue of the one-child policy, the growth in the workforce age population, 15 to 64, is actually set to peak in China just 5 years from now. So the United States long-term prospects for economic growth are somewhere between 2.5% and 3%, and that compares very favorably to the long-term outlook for growth in Europe and Japan. Let's shift gears and talk about inflation just for a second. And again, I'm repeating myself with respect to the CPI and core CPI chart, but I think it's important because so often you hear people complain that, well, the Fed and so many economists are always talking about core CPI. Well, that's great if you don't eat or drive. But my point with this chart is to suggest that, wait a minute, not so fast. Core CPI actually does serve as a good, smooth version of the headline number through time. People remember all about the surges in headline CPI, but they forget all about the dramatic contraction in the headline number when food and fuel go into the tank. The big picture here is the fundamental trend in core CPI has been doing this, and the Fed is saying in this bottom panel here that their longer term, meaning looking out through 2015 forecast for the PCE deflator actually continues to be very benign. The Fed's party line has been, don't sweat rising inflation anytime soon. I'm putting numbers to their forecast here. This is from the most recent published forecast from the Fed. Why do they say this? Well, because, first of all, I wanted to bring this data to your attention. So much focus on food and energy inflation, and no question, at the margin, food and energy can whip the inflation numbers around very dramatically. But I think it's important to understand that food and energy combined are just 14% of total personal spending, whereas if you add healthcare and housing together, it's 38%. Of total, 33% of total. So I just think it's important to keep this in perspective. Yes, food and energy as a percent of total family budgets has increased a little bit here from about 12.5 to 14% in the last couple of years, but actually it's come down very dramatically in the last 3 decades. Food and energy actually have been are cheap by historic standards. So yes, we've seen this rise. We see a lot of volatility in the data series, but food and energy actually are a relatively small piece of the average American family budget. And in this chart, what you see is the best measure of food and energy inflation is captured very specifically in this data series, PPI crude materials. Okay, so again, what you're looking at here in the gray data series is food and energy inflation very specifically. And so when Ben Bernanke says, I think this will be transitory, I think he's looking at this chart. Historically, you can see the very pronounced volatility. So you can see in one given quarter, 50% increase year over year in the price of food and energy, but then you see a subsequent plunge. In other words, the volatility is there. And I guess the takeaway from this chart is, yes, there's no question that food and energy ultimately feed through into the underlying inflation figures, but on a very muted basis and with a lag. And so Bernanke's point today is if we see food and energy prices come off like they have done historically, then probably the impetus for higher inflation too will fade. But the big picture is that, look, at 2% CPI, they at the Fed are not worried about rising inflation anytime soon. What about the Fed printing money? This is an argument you so often hear. I just wanted to make this distinction. It's so important to understand the difference between the monetary base and the money supply. When you hear people talk about the Fed printing money, whether they know it or not, they're referring to the monetary base. And that is a very different animal than the money supply. And what the Fed's point is, and economists generally consistently make the argument that, look, unless and until you see the money supply start to increase at an accelerating rate, you don't worry about inflation. Most recently, the rate of change in the money supply has been 5%, up from just 1.6%. So with monetary policy, in other words, QE1 and QE2 is visually illustrated in this chart. The Fed has been trying to stimulate the economy. What they've been trying to do is make the needle move on the money supply with this monetary base expansion. And the needle is gradually starting to move. But the Fed is saying, look, number one, we're going to take this stimulus back when we think it's time to do so. And number two, unless and until you see M2 growth start to really accelerate, we're not going to be concerned about rising inflation. And remember that nominal money supply needs to grow at the nominal rate of GDP growth over the long term in order not to have deflation. So a recovery to 5% is only a recovery to the rate of growth in money supply that will support non-inflationary 5% nominal GDP growth. And that translates to about 3% real GDP growth, which is exactly where you want to be. The inflation expectations in the bond market are what I always look to. In other words, historically, I think bond investors have been the best at sniffing out the long-term prospects or problems with inflation around the bend. And I just wanted, again, to highlight this notion that if you look at the tip spread, the best market-based proxy for investor expectations for inflation. As a matter of fact, this thing has come off pretty dramatically. So what this is saying is that bond investors are not sweating rising inflation around the corner pursuant to the Fed printing money or any other argument. And the long-term implied inflation expectations in the tip spread is about 2.25 today, lower than we saw for most of the decade, last decade. Okay, can we afford not to attack the entitlement programs in wrestling with this enormous federal fiscal problem? And the answer is no. The bottom line is that Medicare and Medicaid are the problem. I make that that's a very very straightforward statement, and I think it is I do that because the facts are very straightforward. What you're looking at here is the CBO's most recent long-term, looking out to 2050, just simply grinding out the numbers based on the current legislation. In other words, if Congress did nothing, if our politicians did nothing to address the problem, this is their best guesstimation as to what happens with respect to total federal spending as a percent of GDP. So what you see here is the numbers improve as we come out of recession because the denominator is growing. But in the long term here, then federal spending as a percent of GDP actually gets absolutely wildly out of control. And you can see here that Social Security is not the big problem. Yes, the width of the gap on Social Security, in other words, Social Security percent of total GDP, widens over the next decade as all those boomers hit retirement, but then Social Security more or less stabilizes, and you can see all other federal spending is expected to actually decline as a percent of GDP. It's Medicare and Medicaid, period, that have to be dealt with. And the problem is that as those two entitlement programs continue to take an increasing share of GDP, then the debt that accumulates as a result of paying for those simply spirals out of control. The debt service spirals out of control. So that obviously this is an unsustainable long-term situation. And I don't know what happened to my chart there. I got a funny D. But the corresponding, in other words, this chart ties to the preceding chart. It's a calculation of total federal debt held by the public as a percent of GDP. In the preceding chart, it was federal spending, annual federal spending as a percent of GDP, and of course that leads to the total stock of federal debt outstanding. And so obviously this is clearly, this is a Cape Canaveral looking chart, and it's clearly not sustainable. We have to tackle Medicare and Medicaid, just to put that to rest. And then government debt to GDP is in this chart. I just wanted to show you the current ratios. In other words, the IMF most recently calculated U.S. government debt to GDP ratio compared to other countries. And so in 2011, the current year, what they're saying is our ratio hit 70%. And that's what you would conclude based on the numbers from the preceding two slides. And that is not the direction we want to be going. And I guess my point here is, by comparison, we're still in reasonably good shape. In other words, we in this country have time to deal with this problem, but if you did nothing, within a couple of years you become Portugal, and ultimately you become Greece, and you default on your debt. Clearly something has to be done. I wanted to just make you aware that this data is included in this slide, taxes, because taxes are going to be a headline discussion through the next election. This is simply a breakdown of the total tax take, federal, state, and local, including property taxes. If you're curious as to where the sources of revenue at all levels come from, this is the chart. Now, the related question, because it's political season and because we're debating whether or not the tax structure and system is fair, is the discussion that I'm addressing in this slide. In other words, I keep hearing some politicians saying, well, we need to raise tax rates because the system's not fair. Well, fair is in the eye of the beholder. You decide what's fair. I just wanted to show you the numbers. What you're looking at here is the share of total income earned versus the share of total taxes paid by the top 1% of tax returns and the top 10%. And so the point here is that over the last 2 decades, the share of total income earned by the top 1% has gradually been increasing, but so has the total tax burden borne by the top 1%. And in fact, the width of this gap actually appears to be widening. So you tell me, is it fair that the top 1% earned 20% of total AGI but paid 38% of total taxes in 2008? I don't know. Do you want this? Do you want the tax structure to be any more progressive than that? Again, it's in the eye of the beholder, and it's a philosophical question. But the related statistic for the top 10% is top 10% earned 46% of total AGI and paid 70% of total taxes. And you know also the related statistic that the bottom 47% of total AGI earners pay no taxes, no income taxes. So I don't know. I think it looks pretty fair the way it is, but not everybody agrees with that. I wanted to let you know that this chart exists, and it's here, because when you get into a period of jitters, I always go back to this chart, S&P 500 versus crises. Keep your perspective. And so this is a long-term chart going back to 1957. And you can see how the stock market has, through thick and thin, through decade after decade, crisis after crisis, continued to deliver long-term equity returns approaching 10%. And I recently prepared this chart, so this is a brand new one. But I think the shorter term, our memories are awful short in this business. And the reason, what got me thinking about preparing this chart was, okay, from the most recent peak in the market here in April to the latest correction of about 1,300, it feels pretty ugly, and everyone's talking about soft patch or double dip once again. Well, again, you remember last summer from 1,200 to 1050? Well, that was what, a 15% correction, and you know, from peak to trough so far, it's what, 4%, something like that. The other, and anyway, I just wanted to show you, let you know that this data exists here because all this stuff is so interesting. And again, how quickly we forget what all the concerns were just a year ago. The other thing that I think is real interesting is, again, I referred to Rosenberg and Rubini and others, but it was interesting to me when I looked up. I remember Rosenberg said double dip recession is a virtual certainty, so I looked up the data on which he said that not quite a year ago, and that was right here. and so the stock market is up maybe 20% from the date Rosenberg claimed that we were headed into double dip. It was a virtual certainty. So it's not to say that, you know, he's not a capable economist and so forth, but keep that kind of talk in perspective. And I personally don't believe it for a minute, but you know, other people have other opinions. Okay, shift gears and talk about the stock market. It looks like I have about 5 more minutes on this call, and I promise to conclude the call in 6 minutes at 3 o'clock my time, 5 o'clock Eastern time. What drives stock prices? In other words, what is the outlook? What's the most reasonable outlook for the stock market between now and the end of the year? Well, the answer, as all of you on this call know, is ultimately you can talk about crises, you can talk about all different aspects of the global economy and political situation as we are reminded in these 2 charts. But in the end, there is one thing and one thing only that drives stock prices, and that is corporate earnings. You apply a PE ratio to corporate earnings, and you get the market's level. Okay, so again, this chart is my favorite chart in this whole chart pack, and it's the one that always that is never not in the chart pack. It's always the one that I come back to with respect to the stock market, and here's why. It so clearly illustrates the historic relationship between stock prices and S&P earnings. if you showed this chart to your 4-year-old granddaughter and said, honey, if the red line goes higher, what's the black line probably going to do? And she would say, well, I think if the red line heads toward these 2 red dots here, then I think the black line correspondingly will go higher. What are the red dots? The reddest dots represent today's consensus bottom-up earnings forecast for the S&P 500 for this year and next year. And the lighter dots, I looked this up and I modified this chart just in the last couple of weeks, showing that we started this year here, and the footnotes here make this very clear, but the beginning of year, in other words, as we went into 2011, the consensus bottom-up earnings forecast for this year was $96 a share, and lo and behold, it's over $101 today. And this in the face of all this double dip and economy slowdown. In other words, the point here is that feet on the street analysts in Wall Street, the people that call and talk to company managements day in, day out, week in, week out, actually, despite all of the negativity on the immediate prospects for the U.S. economy, continue to conclude that, hey, our business doesn't look bad, and in fact, it looks like we have to revise our earnings estimates up a little bit. So, in other words, revisions have not turned down, they've continued to get bumped higher. The bottom line is that if you fast forward 7 months, 6 months to the end of this year, and apply a reasonable stock market PE multiple of 15 times, $100 a share, let's say in round numbers, you would be at 1,500 on the S&P 500 between now and the end of the year. And I say, I don't know if we're going to hit it, but I just wanted to show you the data, the numbers that make that target very reasonable. I've noted that most strategists in Wall Street are somewhere between 1,400 and 1,500 in their year-end targets for the S&P 500, and the way they're getting there is with a look at this chart. The last point I'd make is, look, earnings never have and never will grow in a straight line. But we are well underway in this cyclical earnings recovery, and I think, based on all the economic factors that I've considered, that this earnings trajectory is highly likely, and that's why I think stock prices continue to work higher despite perhaps lots of volatility and maybe another further setback over the summer. I think by the end of the year, stock prices are substantially higher. Okay, just a quick commentary on the end of QE2. It turns out that QE is driving the bond market precisely opposite to what most people expected. Most people, when they talked about QE, expected that when the Fed exits the market as a significant buyer of treasuries, probably interest rates go higher, bond yields go lower because you're taking a big buyer out of the market. And in fact, it's worked exactly opposite to that. And why? Because QE is viewed by investors as inflationary policy. So when QE goes away, investors are believing that, hey, inflation probably is less of a prospect, less of a problem, and maybe even we have some economic slowdown such that bond yields go down. Interesting, once again, I'm highlighting the quotation from one of the luminaries in bond land, Bill Gross. I just think it's interesting to document this stuff, but on March 2nd, Gross said, with the end of QE, bond yields are likely to go higher, maybe even lots higher, and lo and behold, bond yields promptly turn down. And it's because people really do believe that probably we're not going to have QE3, we're going to have the Fed exiting that whole policy, and if anything, it'll be disinflationary or deflationary, and maybe bond yields continue to work lower from here. In other words, it's not a given that at the end of QE, bond yields go higher by any stretch of the imagination. And in this chart, you can see that this is the historic record of all those highest paid economists in Wall Street's forecast for year-end bond yields. End of 2011 expected yield on the 10-year Treasury. Most recently, the expectation, the consensus forecast is 3.87 on the 10-year Treasury, and lo and behold, we've hit just recently 3%. So if the economists and strategists in Wall Street are correct in this, bonds could get real ugly between now and the end of the year. But as a matter of fact, I'm not so sure that these guys aren't going to turn out to be pretty significantly wrong. Quick commentary on high yield, because I get this question pretty frequently. Yes, high yield bonds look like the yield on high yield is awfully low, and maybe there's no opportunity, but I do think it's important to understand that the spread to treasuries actually remains elevated by comparison to what we saw during the last decade of consistent economic expansion. The spread to treasuries is still 500 basis points. So I suspect at a minimum you'll collect the coupon in high yield, and high yield's not a bad place to continue to be. And I also believe muni bonds are still on sale. I wanted to show you the historic spread of munis to treasuries. Yes, we've had some improvement in muni pricing, but munis spread to treasuries still looks pretty darn attractive. And why is that? Well, Meredith Whitney and others have been talking all about the nightmare scenario, but I think it's important to understand basic state and local government finances have actually turned the corner very significantly. You can see that beginning over a year ago, revenues once again exceeded expenses, and we are in a healing process. And I'm talking in broad gross terms here. That's not to say you couldn't have some blow up somewhere in a high-profile muni credit, but I think on average, municipalities, state and local governments are improving financially, and they're also going to continue to get religion, I think. I'm going to skip over discussion of commodities. The punchline here on commodities is that historically, the GSCI, this is meant to be an investable type index. In other words, it's meant to be a proxy for what you could actually have achieved by investing in commodities over the last 20 years. And the punchline is that investing in commodities hasn't held a candle to common stocks long term, although in certain periods of time, in certain years, you have inverse correlation, very strong inverse correlation, which is a reason perhaps to own commodities in a portfolio so you have reduced volatility over time, better risk-adjusted returns over time. Okay, the last segment here, and I apologize, I am going to go 2 minutes over, but I wanted to make not omit to make this final commentary. If you've listened to me before, the punchline with respect to investment strategy is, look, I've now spent an hour of your time talking about macroeconomic things, the economy, the inflation outlook, fiscal policy, all of these macro things, all very important to all of us as citizens as well as investors long term. But in reality, when it comes right down to designing a client portfolio, in other words, figuring out what to do with your client's money, should any of this macro stuff really influence how you structure a portfolio? And surprisingly, my answer to the question, maybe surprising to you, maybe not, but my answer to the question is, nope, it's not particularly important. In the end, trying to apply tactical asset allocation based on your forecast for the economy, for interest rates, for earnings, and on and on and on is a losing proposition. It's a loser's game. Here's my evidence for making this claim. At the beginning of 2010, let's ask ourselves, let's go back and look up what the highest paid strategists at the highest profile Wall Street firms, buy side and sell side, were telling us to do with respect to S&P sectors. And so in January of 2010, that cast of characters, the luminaries that the talking heads you hear on CNBC every day, hands down, we're recommending technology, and secondly, we're pounding the table on industrials, and third favorite was energy. Okay. Well, I just wanted to highlight this. Their tech call was an enormous disaster. And conversely, you see tech was the most highly favored sector, and it came in 8 out of 10. It was a huge disappointment, a huge disaster. Conversely, they were panning the consumer discretionary sector because because the overarching economic forecast was that we weren't going to see a consumer-driven recovery anytime soon, so why would you want to own consumer discretionary stocks? And in other words, they were buying the new normal hypothesis. Well, it was dramatically wrong, as you saw in that recovery in retail sales slide that I showed you. And lo and behold, the consumer discretionary sector shot the lights out last year, and they were panning it. So my point here is that in the aggregate, if you listen to Wall Street last year, you probably significantly trailed the S&P 500's 15% total return. How about this year? And this is where I actually I have to chuckle when I put this together, because I just looked up the data through June 3rd. How are they doing? And that was one of the questions I posed here that we would address in today's call. I just find this so fascinating. Once again, just 5 months ago, the Barron's cast of luminaries among stock market strategists were pounding the table on technology. Maybe one of these years they'll get it right. By the way, this is the 6th consecutive year that they said tech would be the best performing sector. And lo and behold, year to date, tech is number 8 out of 10 sectors. They had a huge miss in utilities. They were panning utilities, and utilities are number 4 and up 5% year to date. A huge miss with healthcare. They panned healthcare, and healthcare is the number 1 sector year to date. And likewise, they panned consumer staples, and staples are number 3, up 6% year to date. Again, the whole point of this analysis is, I've been doing these report cards now for many years, and my point is that I don't believe that anybody, in other words, if the smartest people in Wall Street can't systematically add value with tactical asset allocation, what makes you think you can do that for your clients? I just don't think you can. So my pitch to you is you stick with modern portfolio theory. It is still the best investing mousetrap yet devised. And these are the 3 legs to the stool. No surprise to any of you on this call. This is what we've been trained to do, trained to advise our clients to stay broadly diversified and periodically rebalance. Now, I want to prove to you, at least in my mind, that this has been the best investing mousetrap yet devised based on my calculations. I asked myself, and again, I'm repeating myself this month for those of you that have been on this call, but again, this is the area of this presentation that deserves monthly repetition. I just think this is so important because I think so many advisors are so tempted to get involved in tactical asset allocation because they want to make an extraordinary call. They want to shoot the lights out and look smart to their clients. I'm saying don't do it. You could shoot yourself in the foot very badly. What I did here was to construct a portfolio, hypothetical portfolio going back 10 years, and I'm using indexes. So you can't accuse me of cherry-picking mutual funds or ETFs. And so we're going to stay broadly diversified. This portfolio consists of 50% stocks. It's a pretty conservative portfolio. Bonds, real estate, commodities, and it's global. Non-U.S. stocks, emerging market stocks, non-U.S. bonds, and so forth. How would it have done over the last 10 years? In other words, the question I'm addressing here is if you applied modern portfolio theory in a very plain but vanilla fashion, in a disciplined fashion, plain vanilla with periodic rebalancing over the last 10 years, how would you have done? And the answer is that portfolio generated 8.4% total compound annual return compared to the S&P in a classic 60-40 portfolio. Sure, you had this very violent contraction through the bear market. There was nowhere to hide. But my point is, had you stuck with the program and had you not bailed out, as so many investors without professional help were wont to do, you came out the other end looking pretty darn sweet. A corollary here is probably variable annuities. As much as many advisors turn up their nose at variable annuities, increasingly I think that the evidence is that's a very viable product, very viable value proposition for many investors. Yes, you're paying the issuer 3 points, but in return for that, you're getting much reduced volatility, at least with respect to expected lifetime stream of earnings. And the final point I'll make this week is, okay, because this month is because so many advisors then are confronted with this question, well, okay, if I buy modern portfolio theory, how do I do it, active or passive? In other words, actively managed mutual funds or passive ETFs, or a combination of both. And I just wanted to point out and highlight the fact that this research exists. You can Google up this FunQuest study. It's fascinating and it's a very important study. And the answer, the punchline here is that passive is not always the best approach. In other words, I'm making this case, I'm making this point very assertively because I think it's true to say that John Bogle and other purveyors of index products have been, in fact, very effective at selling their story. I think if you ask John Bogle at Vanguard, he would say indexing always and everywhere is probably optimal. And the point is, the research suggests that, no, that's not a true statement. And so in this study, for example, going back, I forgot how bad, 30 years, and looking at virtually every fund category, what they realized, what they concluded is that no, in 23 out of the 73 categories studied, active actually on balance outperformed passive and vice versa. So the point is that if you are diligently applying modern portfolio theory and your job is to optimize, then part of your job and part of the reason you're getting paid what you're getting paid is to spend the time to find the best product style box by style box, and that's what's called optimization here. And those products may either be active or passive, and your clients deserve your time spent on finding at least the best to the best of your ability what's best. And I guess I say this with some passion because I represented a mutual fund company for many years. It is absolutely true to say that there is a handful of active mutual fund managers who have consistently beat the benchmarks over the long term, but the percent that are able to do that is very small. But they do exist, and you need to spend some time and go find them. Okay, that's it. And I swore to you that I wouldn't go over an hour, and I did. But I hope you found it useful. And at this point, Brian will open it for questions.
Thanks, Fritz. Sorry to everyone we went over. If you do need to leave, you can do that. If you want credit, you just need to enter your CPID in the post-webinar survey, which will come up automatically when you leave. If there's a problem, just email us. We're just going to take 5 minutes of questions. Then we'll any ones that we can't get to, Fritz, if you can post a blog answering some of those most important questions that I send you. But let's take a few now, if we can. And if you have any more questions, anyone, just please chat them into us, and we'll answer a few now. And otherwise, you can check out his blog. A first question is, does increasing employee compensation lead to stronger labor rates, which ultimately would lead to higher inflation? What's the connection there? Isn't there a connection between higher compensation and inflation?
There's a huge connection. It's a great point you make with that question. The biggest single driver of inflation is wages. And it's a little hard to pin down because in the actual computation of the CPI, you don't specifically see a line item called wages. Goldman Sachs was the most recent study that I remember, and what they concluded is that ultimately about 70% of the CPI is traceable back to wage inflation. And one of the reasons that the Fed is so sanguine about the outlook for inflation is that with record high unemployment and slack in the economy as measured by capacity utilization, then is anybody expecting a nice bump in their paychecks anytime soon? I can't find it. None of my friends think that's going to happen to them, and I don't think so. In other words, there is no wage inflation, significant wage inflation anywhere on the horizon for the time being. And that's the single biggest driver of the CPI. And again, that's one of the key reasons that the Fed has been saying what they've been saying, whereas they've been saying, hey, don't sweat rising commodity inflation. First of all, it's so volatile, and secondly, commodities as a share of total cost input for the U.S. economy is actually quite small.
Okay, so essentially, we'll also, I guess, the high unemployment rate would keep the growth in employee compensation in check.
Yes.
Is that correct? Okay.
Yeah.
Now,
I mean, to the extent there's any benefit in high unemployment, it's keeping inflation in check. It's not something we want to see, but in the meantime, it means that it very likely means that we aren't going to have to sweat rising inflation anytime soon.
Now, with unemployment so high, do you see that bouncing back unless without coming up with new industries and complete new jobs? Do you see it coming back without those new industries?
I guess what I can say is, look, this recovery will trace out. We'll see a repeat of gradual recovery in employment in this recovery, just like we've seen it historically, and it involves existing industries and companies rehiring or adding to headcount, and it also does involve over time the creation of new industries and companies, but I don't see that as an element of this recovery in total employment any different than its contribution to the total employment pie in previous recoveries. I hope I made myself clear there, but it's a combination of both, and we don't have to necessarily rely on industries that come, greenfield industries coming out of somewhere to drive a recovery in total employment. Our existing companies and industries will make huge strides in that direction once they regain confidence that this recovery is sustainable.
Isn't the federal spending on Social Security just the interest on the federal borrowing from the Social Security Trust Fund?
Would you repeat that, please?
A question here from Michael. He's wondering if federal spending on Social Security, isn't it just the interest on the borrowing from the Social Security Trust Fund?
Interest on borrowing. Let me.
So essentially, people pay their own Social Security, and
yeah.
So wouldn't the federal expense of it just be what they're taking out, borrowing from the trust fund? That's his question.
Let me just give a quick description of how it works. The trust fund is a fiction, and so my advice to anybody that's trying to figure this out is just forget about any discussion of the trust fund, because what the trust fund amounts to is the Social Security program having deposited its Social Security receipts with the Treasury, and the Treasury has issued them non-negotiable Treasury bonds. And so the reason I say it's a fiction is because when those assets are depleted, the federal government is simply going to have to go into the market and issue bonds with which to make Social Security payments. And so the best way to look at the cost of the Social Security system is in the chart, that one chart that I showed you, Social Security payments as a percent of GDP. And just pay no attention to any discussion of the trust fund because it's two entities of the government, debt obligation and credit obligation between two entities of the government. In the end, you have to net it out anyway.
No,
probably not a very clear answer, but
that's all right. Now we keep hearing about Spain being another debt bomb, but your graphic showed that that they're not in as bad financial shape as the press would lead us to believe. Now, if you could just maybe you could bounce back to that graphic of the debt to GDP, I believe it was. But what do you think about it? Is Spain a major risk for us? A lot of the presentation has been focused on the U.S., but it seems like Europe is a big problem.
Yeah, good. I think that yes, and the big concern today, very similar to 1 year ago, was do we get a domino effect? In other words, if Greece ultimately has to restructure its debt, meaning the owners of Greek debt have to take write-downs, then does that mean that Portugal, owners of Portuguese debt, have to do the same thing, and ultimately owners of Spanish debt have to do the same thing? That's the domino effect that I'm referring to. And the answer, at least in my mind, is probably no with respect to Spain ultimately. And the reason I say that is, first of all, Spain's debt to GDP ratio is significantly lower than Greece or Portugal. And secondly, it looks to most European officials as though the Spanish government is taking effective fiscal austerity measures such that they can manage their deficits down and hence manage to cap the debt to GDP ratio for Spain. And that's not appearing to be the case for Greece. So my point is that, yes, I think clearly the holders of Greek debt ultimately are going to take a hit, and probably Portugal as well, but I don't think it's domino effects to Spain. That's the nightmare situation that Europeans are really worried about. I don't think it happens, and I think the European officials broadly, governments and the central bank, will do everything in their power to be sure that it doesn't happen to Spain, whereas in the end I think they will allow Greece to restructure.
Now, actually read an article, John Molden came out with a great article in his newsletter which addressed just that yesterday, where he talks about how Iceland took the, kind of didn't want to pay their default, their debt servicing, whereas Greece, it seems like they're very in danger of that. Now, if this domino effect happens, which in many cases may make more sense when you're looking at how Greece's debt, how overwhelming it is, and others that are getting to that point. If that domino effect happens, what can the U.S. Still succeed economically? Can they, or will it? What do you expect the effects in the U.S. if that were to happen? And are you just discounting that possibility?
Yeah, no, and this is an area of a lot of uncertainty and so forth. But I think what the stock market and the bond market in the United States have been concluding, this is an aside, but I think it's an important aside. Go back to that stock market chart that I was pointing to, and I was comparing this summer's sovereign debt crisis and its effect on the stock market to last summer's. Last summer it was a 20% correction. This year it's been de minimis, and I think the reason for this is that U.S. investors, with respect to U.S. stocks, are concluding that even if Europe is headed for a lot more trouble than anybody currently expects, the ripple effect on the U.S. economy is probably I don't want to say it's immaterial, but the negative impact, in other words, the mechanism whereby Europe ultimately could hurt the United States economy is through the banking channel more than anything else. In other words, our exports to Europe are not that significant to us from an economic standpoint. It's the banking system ultimately, the effects through the American banking system possibly emanating from, let's say, a Spanish default. And the answer is U.S. banks own very little of any kind of Europe debt. Most of the bad debt issued by Greece, Portugal, and Ireland, and potentially Spain is held by European banks. And the French banks are most exposed, German banks are second, and so forth. So I would say, and I don't mean to minimize or just ignore this potential threat to the global economic recovery, but I think increasingly U.S. investors are concluding that it's more of a Europe problem than anything else, and the United States has increasing linkages with Asia in terms of economic prospects, and to that extent we're somewhat insulated from this European problem, European contagion.
Great, thank you, Fritz, for that great explanation there.